In this video, we expect to learn the following. 1. Why start early? 2. The power of compounding interest. 3. Importance of long-term investments. 4. Company's fundamentals. All 4 will surely help us in our investment journey. Let's dive right in. Born in 1930, Warren Buffett displayed an exceptional interest in finance and investing from a young age. He started investing in stocks at the tender age of 11 and began honing his skills early on. It wasn't easy for him. Even at 11, he made a lot of mistakes, but there is one spirit he had, which we must emulate. The resilient spirit of not staying down, something we must all emulate. I remember thinking of mistakes as failure. My study and research about great men made me to understand that as a man, they all made a lot of mistakes. Now, let's dive into the concept of stocks at 11. This term, coined by Buffett, signifies the importance of long-term investing and the power of compounding returns. He started at 11, but never gave up for years and years. This concept also emphasizing the essence of starting early, but it is better to start late than not starting at all. Most great men started after 40, but it is better to start earlier. Warren Buffett's philosophy centers around investing in companies with long-term potential and holding on to those investments for extended periods. This idea works with the concept of compound interest. I have a video on the power of compound interest. Please do to check it out, but before we continue, if you are new here, please hit the like button and subscribe to our channel to get more content like this. Buffett famously advises investors to focus on a company's fundamentals rather than short-term market fluctuations. If you want me to do a video on company's fundamentals, please drop a comment in the comment section below. He believes that by thoroughly analyzing a company's financials, competitive advantage, and management team, investors can make informed decisions that will pay off in the long run. These are skills he learned over a long period of time after so many mistakes. We have a complete video on Warren Buffett's biggest mistakes. Please, you can check it out. Warren Buffett's investment portfolio includes iconic companies like Coca-Cola, Apple, and American Express. By investing in solid, established businesses with strong competitive advantages, he has reaped incredible returns over the years. So how can we apply the stocks at 11 principle to our own investment strategies? Well, it starts with doing thorough research and identifying companies with enduring value and strong growth potential, buying into their company's stocks. It's crucial to focus on companies with a sustainable competitive advantage, solid financials, and a strong management team that has a long-term vision. Just like Warren Buffett, we must also have the patience to hold onto our investments for the long term and not get swayed by short-term market fluctuations. Remember, successful investing is not a sprint but a marathon. It's about identifying quality companies, staying disciplined, and allowing time and compounding to work their magic. Please note, the secret behind every great investor is their ability to detach their emotions from their investments. It's important to note that market noise always gets the better part of so many. Only the brave survive. Please don't get me wrong. Don't mistake ignorance for braveness. Study the market, make your prediction, and wait for it to play out. And if it doesn't work in your favor, cut your loss. So, fellow investors, let's take a page out of Warren Buffett's playbook and embrace the power of stocks at 11 to build a solid financial future. Invest wisely, think long-term. Thank you.